On the 26th of November, Rachel Reeves will deliver her autumn budget. Yet again, she has a big hole to fill, and if Labour are not willing to cut spending, then it's expected that Reeves will need to find £30 billion by raising taxes. Just like last October, there is a huge amount of fear and speculation about what taxes could change, and this is largely caused by the government themselves, endlessly leaking potential ideas, refusing to rule out any changes and pushing the budget back by a month. But also because of the media's constant, often unfounded speculation about what changes we'll see, from limits to ISAs and further increases to capital gains tax and IHT, to new property taxes and radical changes to pension tax relief and tax-free cash. As a financial advisor, I see firsthand the stress and anxiety that this is causing. Last week, I had a client say that it feels like I'm just sitting here, waiting for the bombs to drop and praying that they don't blow up my business or my retirement. I'm sure part of you feels the same way too, which is why I needed to make this video. I have seen so many half-baked opinions and unhelpful suggestions online that I think are causing unnecessary stress and may push you into making decisions that you come to regret. So, just as I did last year, I'm going to help you cut through the noise. Look at what the government has actually said and what is pure speculation, what changes may be introduced, and most importantly, when. If Reeves announces a series of changes on the 26th of November, but they don't come into effect until the start of the next tax year, then clearly spending time now speculating about what these changes may be is a waste of time. All you'll do is get yourself riled up by a bunch of far-fetched ideas that will probably never come to pass. The writing is on the wall. Taxes are going to rise. But if you can't do anything about it, then you're better off shutting out the noise, waiting for the changes to be announced, and then only updating your plans once you've had time to digest the new rules. If, however, Reeves announces changes that come into effect immediately, then there may be actions that you can take today to protect yourself, like making a gift before IHT rules change or taking tax-free cash from your pension. At this point, it's important to remember that no one, not even the government themselves, knows for certain what they are going to do. But what I think is much easier to determine is when these purported changes may come into effect. In many cases, it's obvious that these changes could never be introduced immediately, so there's no point in stressing about them now. Whereas with others, there is a real possibility, and in these cases, in certain personal situations, it may make sense to take action now to protect yourself. Let's start with ISAs. We know that the government is looking to make changes to ISAs. Reeves said so in her Mansion House speech in July. There has been no sign of wanting to cap stocks and shares ISAs or any other radical changes like that. In fact, I'm going to have to stop myself there because that is no longer true. Whilst I've been editing this video, I've just seen this article from the FT, which suggests that Reeves is now considering forcing stocks and shares ISAs to hold a minimum allocation to UK equities, perhaps as high as 25 or 50%. This is exactly what I'm talking about. The government leaks yet another half-baked idea to the press, and the next thing you know, it is front-page news, causing unnecessary stress and confusion. The source is the classic, vague, people briefed on her thinking, and it gives just enough information to wind you up and get you thinking the worst. When in reality, I expect the government themselves have probably not even thought this through, and it will probably never come to pass, at least not in the way that this article is suggesting. The premise of the idea is not actually unreasonable. Imagine if, say, ISAs did not exist and the only other option was to invest via a taxable investment account. But then the government comes along and said, hey, we're going to open this new tax-free investment account, but you need to invest 25% in UK assets. You'd probably say, well, thank you very much, at least for some of your money. But the problem is that ISAs do already exist. So are they really going to force everyone to sell their existing ISA holdings and invest in UK stocks? What about all of the people who don't have the risk appetite for that? Will they have their ISAs that they've spent years accumulating revoked? And how do you even define what a British company is when so many of them are international? And what is to stop people just offsetting this by holding less UK assets in other parts of their portfolio, like their pension? And I thought the plan was to simplify ISAs, not make them a hell of a lot more complicated. Even if something like this is announced in the budget, the complexities of implementing it would require extensive consulting with ISA providers, which could take years, during which there is still a good chance that it could be scrapped by Labour themselves or the next government. just like what happened with the British ISA. But of course, you don't get any of that context in this article, which is why this is the type of article that I think is best ignored, the type of noise that you need to block out. The other leading rumour is that Reeves is looking to reduce the cash ISA allowance to £10,000. Although this would be easier to implement, we only ever see changes to ISA allowances come into effect at the start of a new tax year. So there's no point in worrying about this now. So for now, try not to get sucked into articles like this, and let's just see what happens in the budget. Now, back to the original video and capital gains tax. Last year, Reeves increased capital gains tax from 10% to 18% for basic rate taxpayers and from 18% to 24% for higher rate taxpayers, with this change coming into effect immediately. Now, you might think that due to the recent change, we won't see anything this time, but many people think that capital gains tax is broken and needs serious reform, and I have to agree. Let me explain. You may have heard reports in the press that influential think tanks like the Institute for Fiscal Studies have been calling for CGT rates to be aligned with income tax rates. Although this is true, what the press often misses is that the IFS actually thinks that raising CGT rates on their own would make things worse. Imagine if 10 years ago you bought a buy-to-let property for £100,000 and since then its value has increased in line with UK averages to £143,000 today. If you sell that property, you've made a £43,000 capital gain. If your £3,000 capital gains tax allowance is available, then you'd pay 24% capital gains tax on the rest, assuming you're a higher rate taxpayer, leaving you with an after-tax gain of £33,400, which might sound good, but that's before we consider inflation. According to the Bank of England, today you would need £139,000 to buy the same amount of goods and services as what £100,000 would have bought you back in 2015. So in real terms, before tax, you've only just made a profit, but you're then paying all of that profit and more to the government. And if they increase capital gains tax to 40%, you'd be in even more of a hole, leaving you with two options. You can either sell the property, pay the tax, and take your £127,000 and invest it elsewhere, perhaps in another rental property. Or you could keep your £140,000 property, keep receiving that higher rental income, and if you need any money, take out a mortgage and invest that elsewhere. Which do you think you'd choose? I hope this simple example demonstrates why capital gains tax is largely a tax on inflation, which penalizes long-term investors and distorts investment behavior by forcing people to hold on to assets for longer than they would like. And clearly, the higher you push CGT rates, the worse this behavior gets, and the more it deters people from investing, which is bad for everyone. So although the IFS does suggest that CGT rates should go up and perhaps even be aligned with income tax rates, this is only if a bunch of other reforms are introduced, like implementing some sort of indexation or capital gains tax allowance that rolls up over time. So investors are in effect only taxed on capital gains after accounting for inflation, as well as a way for investors to roll over or offset capital gains so they don't feel locked into investments. But what are the chances of changes like this actually being implemented? And is there anything that you can do to protect yourself? I think it's unlikely that the government will just tinker with CGT rates again. So if we do see a change here, I expect we'll see more significant reform. There are sensible changes that could be introduced in a tax-neutral way, but given the situation, that's not likely to be the case. So if we do see a change here, taxes are likely to go up, and these changes could be implemented quickly. But that does not necessarily mean that you'd be better off selling an asset and realizing a gain before the budget. As in our example, if they introduced an indexation relief for inflation, this person could actually be better off waiting, and who knows, the rules could even be retrospective. Clearly, these are highly nuanced decisions, so if you are thinking about selling something before the budget, I suggest you speak with an accountant who can help you understand the personal factors you need to take into consideration. When it comes to selling property, however, unless you are already near the end of that process, you're not going to have time to push through a sale now. So although there has been a lot of speculation in the press about property taxes, how they might change or how new taxes might be introduced, there's no point speculating about them now because we can't do anything about it. So let's just wait, see what happens, and then make plans when we have the details. Now for pensions. For most people, a pension is the most tax-efficient vehicle we have for building wealth in the UK. So much so that the Treasury estimates that pension tax relief costs the government £50 billion per year. Given that there is such a big hole to be filled and all of the other big tax-raising revenues have been ruled out, yet again, speculation is rife that we could see significant changes to pensions, with the biggest tax-raising opportunity being in how pension tax relief works, which is viewed by many as being skewed towards higher earners. If you are a higher or additional rate taxpayer getting 40 or 45% tax relief on your pension contributions, then clearly you're getting a much bigger boost towards your retirement savings than a basic rate taxpayer. As such, some think tanks and politicians have supported the idea of a flat rate of income tax relief. In the past, even Rachel Reeves herself has suggested a flat rate of 33% would be a good idea. If there is a chance that a change like this is brought in immediately, then perhaps basic rate taxpayers should hold off on making pension contributions until after the budget, whilst higher rate taxpayers should expedite their contributions to make use of higher tax relief whilst they still can. But let's just think about this. Although the idea may sound simple, this would be a radical change from how pensions have worked in the past. It would require re-educating the population on the fundamentals of how pensions work, making them even more confusing, which might put people off using them. It would also add a lot of cost and complexity for employers, and according to the Pension and Life Savings Association, it would take at least 2 to 3 years to update payroll systems to work in this way. Given that Reeves is backed into a corner, she may decide to push through a change here. However, it seems impossible that a change of this magnitude could be implemented overnight. It would probably take years. If you are a basic rate taxpayer looking to make a pension contribution, you may think that there's no harm in waiting until after the budget and seeing what happens. But as I'll explain shortly, that may come back to bite you. So in summary, I don't think there's any point in speculating about this type of change now. An easier target would be for the government to start applying national insurance to employer pension contributions. Currently, if your employer makes a contribution directly to your pension, it avoids both income tax and national insurance. Whereas if you make a personal pension contribution, you get income tax relief, but no relief on national insurance. This asymmetry has resulted in what's known as salary sacrifice, where employees can choose to sacrifice some of their salary in return for their employer making a larger pension contribution that avoids national insurance. Currently, the rate of national insurance is 15% for employers and between 0 and 8% for employees. So that is a big saving. Scrapping salary sacrifice in its entirety would clearly be a breach of the government's manifesto not to increase national insurance or raise taxes on ordinary working people. But Reeves had no problem increasing employers' national insurance in April. So she could choose to apply some or all of that rate to employer pension contributions. This would yet again increase costs for employers, much of which would likely feed its way through to employees anyway via reduced hiring and smaller pay rises. But it is a backdoor option that apparently somehow enables the government to keep their manifesto intact. If there is a chance that they can implement this change overnight, it may make sense for those who have a salary sacrifice scheme to make pension contributions before the budget to avoid having to pay national insurance. But what if you're a basic rate taxpayer? Do you contribute to your pension before the budget to avoid national insurance, or do you wait till after the budget just in case they increase income tax relief? Or what if there is some other change that we haven't even considered? This is a perfect example of how trying to make financial decisions based on speculation can so easily tie you in knots. It creates stress and often results in jumping out of the frying pan and into the fire. Fortunately, this decision is likely to be already out of your hands, as it's typically hard to make changes to salary sacrifice levels at short notice. Even so, I think it's highly unlikely that a change like this could be implemented overnight. It would of course depend on the specific change, but employers would need time to change their processes, update their payroll systems, and educate their staff on how their pensions now work. So I think that the earliest that this change could come into effect would be at the start of the next tax year. Of all of the headlines in the press, it's changes to pension tax-free cash that get people riled up the most, and that includes me. Currently, once you reach retirement age, you can draw down up to 25% of the value of your pension tax-free, up to a maximum lifetime limit of £268,275. But just as before the last budget, the press has been relentlessly speculating that tax-free cash could be reduced or removed entirely, spamming us with articles that suggest that there is now a flood of retirees taking tax-free cash whilst they still can. A few weeks ago, I was speaking with a gentleman who retired earlier this year, and his decision to retire and walk away from a secure, well-paid job was on the basis that he would be able to take tax-free cash from his pension to pay off his mortgage. Unfortunately for him, he turns 55 on December the 5th, so he's not going to be able to access his pension until a few days after the budget. As such, if Reeves decides to reduce the tax-free cash that he can draw and implements that change overnight, it would devastate his retirement plans. This is a man who has saved earnestly for the last 30 years, only to have his retirement cut out from underneath him by the government's moving the goalposts right at the last minute. There are millions of people across the UK who are in a similar situation, whose retirement plans would be turned upside down if they did this. The press loves pushing this story because it gets so many clicks, and it gets so many clicks because this would be so damaging to so many people. The irony being that this is exactly why it is so unlikely that a change like this would ever be introduced overnight. Back in 2011, the maximum amount of tax-free cash that could be drawn was £450,000, 25% of the lifetime allowance. Over the following years, this was reduced again and again and again. And each time this happened, not only did the government notify us of these changes at least a year before they came into effect, but transitional protections were introduced so that people who were close to retirement or who already had large pensions got to keep their benefits. Keep going back all the way to the 1970s, whether it's a Conservative, Labour or coalition government, when reforms have been made to tax-free cash, existing benefits have been protected. Now, I'm not saying that we won't see changes to tax-free cash. As you can see here, the rules have been tinkered with many times in the past, and I'm sure they will continue to be tinkered with in the future. Who knows? They may even get better at some point. But it is unthinkable that these changes could be introduced immediately without any type of transitional protection, which is again why I think we'll be in a much better position to make good financial decisions after the 26th of November when we have the details of any changes in our hands. One area, however, where we could see more immediate change is with inheritance tax. Last October, Reeves announced that from April 2027, unused pension funds and death benefits would be brought into the value of our estates for inheritance tax purposes, as well as putting limits on business and agricultural property relief. The government has not said explicitly that they are looking to make any further changes, but commentators have suggested that to fill the hole, they could look at introducing a lifetime gifting allowance, above which any gifts that you make during your lifetime are taxed, or they could look to extend the 7-year rule or remove taper relief. These are changes that could be introduced immediately, which means that making a gift before the 26th of November could be beneficial. But these are not the types of decisions that should be rushed. There is no point in prematurely making a gift to your child to try and avoid 40% IHT, and then they lose 50% of it in a divorce, or all of it if it's spent unwisely. So unless you're already planning on making a gift, I think it's best to wait. Think it through properly and see what changes are introduced, especially as these changes could be introduced retrospectively anyway. To conclude, I think that speculating about what changes may be in this budget is largely a waste of time. We all know that taxes are going to rise, but it's highly likely that most of these changes won't come into effect until the new tax year, April 2026 at the earliest, which is why, in the meantime, I suggest trying to block out the noise, waiting for the new rules to be announced, and then updating your plans when you have the information to hand. Of course, I could be wrong, so if you already have plans to perhaps sell an asset or make a gift in the near future, there may be an argument to try and do that before the budget. As I have said throughout, these are deeply personal decisions with plenty of moving parts, so please do seek advice if you're unsure. And this is a reminder that if you are looking for help with your finances, the only way that you can get in touch with me and my team is through the link in the description of the video. These days, there are lots of bots in the comment section and people pretending to be me on Facebook and Instagram. There are scammers everywhere. So please remember that unless you are signed up to my newsletter, I will never contact you directly. Good luck blocking out the noise, and I'll see you in the next one.